Hello, everyone. Good afternoon. Welcome to this webinar hosted by ValueQuest. My name is Abhinav, and alongside me as speakers, we have Ravi, our co-founder and CIO, and Samir. Ravi is our founder and CIO, and Samir, our co-founder and fund manager. The topic of this webinar is Trump, tariffs, budget, monetary policy, non-event or game changers. Over the next 60 minutes, we will try to decode this evolving environment for you. For the last 6 months, we have gone through a phase where Indian markets have been very choppy. The complacency that had set in when the market, since the last 3-4 years, kept going up and up without any meaningful drawdown, is now being firmly tested. Almost all of you would have questions in your minds regarding future direction of the markets, whether the worst is behind, have the sectoral preferences changed, and so on. Ravi and Samir will answer all of these and more. This webinar will be interactive and conducted like an online panel discussion. We don't intend to put up any slides. You are invited to put your questions in the chat room. However, since we will not be able to address stock-specific questions or individual investor portfolio-specific questions, so I'll repeat, since we will not be able to address stock-specific questions or individual investor portfolio-specific questions, I would request you to not put those on the chat. So with this, we are now ready to begin. And my first question is for Ravi. Ravi, there were two big domestic announcements that happened in the last 1 week, budget and the monetary policy. Do you think they can change the course of economic slowdown and tight liquidity conditions that we have seen recently?
Thanks, Abhinav, for that question. Let me just set a little bit of context. If we understand the context and the interplay of the economy, earnings cycle, and the markets, that would probably give a better light and better view of what lay ahead. So, post-COVID, Indian market had been on an earnings upgrade cycle. The corporate profit to GDP bottomed at around 1%, rallied all the way till 5%, and some amount of correction consolidation was probably on the horizon. And what happened is we hit a air pocket earlier last year, somewhere around April, May of the 2024. What was that air pocket? Essentially, government capex kind of took a almost a abrupt halt, and that led to a slowdown in the economy. The number GDP number that came in for the second quarter of 24 turned out to be a disaster, as in 5 point something. It was almost a 2% plus drop in the GDP. The reason that happened is that we realized that we are only basically firing on one engine, and which was the central government capex that was bearing most of the burden. And we needed to broad base our economic growth cycle that has begun post-COVID. So that was the need of the hour. And the reason why, of course, that was the more seasonal reason why we hit a air pocket. The bigger thing from the market's perspective was that valuations were high and we had not seen any kind of a significant correction. But the real reason was that government was embarking or had embarked on a fiscal consolidation path post-COVID, and the pace of which was increasing day by day. So last year we saw almost a 90 bips consolidation in fiscal, and that kind of a shrinkage in the balance sheet definitely is going to lead to a slowdown when there is no other alternative available in terms of pushing the growth. So the thrust in the economy post-COVID of the stimulus was petering out, and government was still consolidating on the fiscal side. On the other hand, RBI kept the liquidity quite tight, the monetary policy quite hawkish, and regulatory nose quite tight. So that also contributed to the fact that the credit growth could not go beyond 12-13%. In fact, we saw credit growth of 15-16%, correcting all the way back to 12%. because of these reasons. Of course, deposit growth is a challenge that the banks need to address for us to grow 15% plus in terms of credit growth. Now, the combination of the actions of government and RBI has led to the slowdown. But the good part is, now that we understand what caused the slowdown, now we can see that steps have already been taken, whether by government or by RBI, to correct all of those. First, in the budget, we saw that government is trying to reignite another engine of growth, which is consumption, without compromising on the capex. So they have kept the capex to budget ratio at 3.2%, which is not a slowdown, but it is flatlining. Essentially, the heavy burden that was being lifted by capex incrementally won't be done by the central government capex. So that was the new engine consumption, and capex continues. Then we saw the outgoing RBI Governor Das cutting CRR by almost 50 bips. That kind of released 50,000 crores into the banking system, and that is a permanent ease of liquidity. And then the new governor, Malhotra, actually announced daily VRR and OMOs. That has already corrected the liquidity situation to a substantial extent, where 3.5 lakh crore of deficit is now down to less than 85,000 crores, and probably in next few days will probably dip into a surplus as well. And we will be able to see the end of the fiscal year through. Of course, seasonality wise, again, we'll get a little bit tight, but I think there is another 50-60,000 crores of liquidity which RBI is going to infuse over the next few days to manage that liquidity. So liquidity perspective, it is not going to be a challenge going forward. On the monetary policy front, we saw a 25 bips cut. There were a lot of experts saying that probably that is not the need of the hour, but I am actually quite enthused by the fact that the larger signaling is that RBI is taking its eye off the inflation and putting its eye on the growth. If you see, they have relaxed the inflation management framework a little bit. So they are not going to be very hard about 4% inflation targeting. So they will be a little bit flexible on that front, and they are anticipating that the food inflation is going to come down from 4.8 to 4.2. The overall inflation is going to come from 4.8 to 4.2, led by food inflation. That will give them the room to probably cut some more rates in the subsequent. At this point, the consensus is that this is going to be a shallow rate cut cycle, but I won't be so sure about it. 25 bips to 50 bips is a given. It could go as high as 100 bips as well. And you have to realize that the starting point of the rate cut cycle is not very high. It's 6.5 we are starting from. We have been in the past at a rate where the interest rate cut cycle has begun from 8%, 8.5%. We are starting from a 6.5. So 100 bips, if it happens to 5.5, will be a great boost to the economy. But that is something that we need to see over the course of next 1 to 2 quarters, how that pans out. And the third is on the regulatory front, and there have been some noises made about being more practical, loosening up the bureaucracy so that the credit can start flowing smoothly. So everything has already started reversing. Now, obviously the question that comes to mind is, why didn't the market react positively to it? The reason is because this takes care of the medium-term growth trajectory. It doesn't take care of the immediate slowdown that we are facing. Also, the second factor is that the valuations definitely have corrected, but they have not corrected enough to say that, this is where I draw the line. This is where the bottom is. Come what may, I am putting my money to work. Their valuations are kind of middling. So it is possible that we might see 2 to 3 months more of some correction or some consolidation until valuations reach a point and until economy actually revives and we start seeing it in the earnings as well. So again, cutting the long story short, the worst in the economy is over. The valuations have corrected. The froth is out of the valuations. Some of them names are beginning to get very attractive. Can it get more attractive? Possible, but next 2 to 3 month time period would be a great period to start building a portfolio. Couple of events which are still lined up and which we don't have clarity to is, one is the tax code. Hopefully nothing negative comes over there. And second is Trump policies vis-a-vis India. And Prime Minister Modi is scheduled to meet Trump on 13th of Feb. Hopefully we'll get some positive surprise over there as well. So from that perspective, these are the monitorables, and this is how I look at the economy.
Sure. Thanks, Ravi. So, Samir, moving on from economic slowdown, which Ravi touched upon, now to earnings slowdown in the last 2 quarters or so. Do you think an inflection point is near and earnings upgrade cycle could start soon, compared to the aggregate level downgrades that we have seen in the last 6 months? And if the inflection point is near, then which sectors are expected to lead any earnings recovery?
Uh, See, earnings recovery takes time for these measures to really start taking impact. And so one thing is that definitely, say for example, the tax cut is going to leave more money in the hands of people. But whether that is going into something which is, consumer staples or some discretionary or some travel, or whether it is going into options trading, we really will find out. But definitely the measures that are taken is going to reverse the slowdown. So what are the things? Basically there are these two things only. Government capex was slow, central government, and this state governments in any case, have very little legal room. Private capex pickup is the joker in the pipe. Now, if you take these three things into consideration, you cannot make a motherhood statement that earning downgrade will reverse or not. I think it is more of K-shaped, where some industries won't revive. There the downgrade cycle will continue, and then there will be some places where we will see. So, say for example, see, consumption is a classic case. 2-3 years of domestic consumption being slow can be attributed to jobs and salaries and whatever else. So this 1 lakh crore is definitely going to add as a booster. So that is an area where you are going to see places where that downgrade cycle will end. For example, you ask for sectors, then that is one. And similarly, there are a couple more where you can surely say worst is over. How it will improve and what kind of a upgrade cycle we'll see is yet to be seen. And the third thing is, the counter to what market is reacting to, that industrial, some of the areas like energy transition, etc. We believe there will not be a downgrade cycle. While people are fearful, whether it is policy driven or capex slowdown driven, etc. But there are some areas within that where we are still confident that those downgrades won't come and earning cycles will pan out. So that is how we look at it. We even within sectors, there will be subsectors like in pharma. If you've heard, Ravi, that within pharma is a large basket. That not everything is going to do well. So there is US pharma, there is domestic pharma, there is CRDMO, etc. So you have to find your niches in terms of where you are seeing that upgrade cycle. So that's the story of India. There are various sectors, subsectors where earnings are buoyant and continue to remain good, and we need to focus on that. That's what I would say.
If I may add, there's a saying that goes that we all lose our heads together, but we come back to senses one by one. So it might not be an across the board earning broad-based upcycle, but there are certain sectors and certain companies which are already exhibiting those signs of earnings upgrade. So our idea and our focus should be to identify those opportunities rather than paint the entire market with the same brush.
Yeah, sure, Ravi. So maybe just continuing with that thought, and so ValueQuest combines top down with the bottom up. So do you feel that the developments of the last few months, you yourself alluded to, Trump, the tariffs, domestic slowdown, and now the recent tax breaks for the middle class in the budget. So do you think some of these events have put ValueQuest's existing themes at risk? I know Samir mentioned about energy transition and that we are still, very confident on that. But you want to touch upon some more themes in addition to energy transition and why you feel they may or may not be at risk. And just feel free to use examples of sectors and subsectors.
Sure. No, thanks for that question. I'll first address the energy transition because that is a big representation in our portfolio, and there are genuine concerns around it. Concerns are all valid, but see, whenever we get bullish on a mega trend, it is not only based on one thing, which is regulation. We need to see technological certainty. We need to see unit economics being in place. We need to see business models that are scalable. We need to see regulations as a tailwind to the theme. So there are many things that go into making a mega trend reach that inflection point from where it takes off. Now, from here, while Trump has signaled opposition to Inflation Reduction Act, let's come to the core of the issue. Everything else seems to be fine, but Inflation Reduction Act is not an act meant only for solar industry. In fact, it is one of the 42 industry that is addressed in IRA. So it is much more complex, and much of IRA's funding is already allocated or contractually committed. And the biggest beneficiary of IRA has been Republican states. Almost 90% of the IRA related investments and job creation has happened in Republican states. So if you say that Trump is a businessman and he's essentially trying to get a win for his constituency, then this would actually be a loss for him if he realizes that if he actually cuts down on IRA, then it impacts his states the most. So I have a feeling that he makes all these noises to essentially get some better deal, or he will say he's repealed IRA, but he might actually come back with, I'm just giving a random name. It will be a Make America Great Again Act. It will come back as that. So it might come in a different shape. It might come in a different form, but it is not going away anywhere. Also, the size of the program over here, it's a $30 billion annually. It's like 0.1% of the US GDP. And the entire energy transition, is dependent on this. It's not dependent on this, but you are going to give away a strategic advantage to your largest competitor, China, in case you decide to go ahead with it. At one end, you want to make America great again by reigniting the manufacturing in US. On the other hand, you are taking away the incentives for manufacturing in America. Then how will you ever become competitive? And then on top of that, you are going to put tariffs and that will make any imports even more expensive. So right now, what is very clear from the playbook that President Trump has used is that he is using all these decoy to extract a better deal out of somebody, or is essentially putting forth a view, but it might not actually be the eventual shape and form that these policies get come back to. So I do feel that this is not something that can be reversed even by Trump, and we will always have strategic importance to this. So today, I was just discussing with somebody yesterday. A lot of people say, why are we, India also, why are we putting tariffs and making our own, power generation expensive? That is a very short-term thinking. One needs to understand that by spending a little extra money, what we are buying is not expensive power or putting capex, which is expensive, but we are buying our energy security, we are buying our energy independence. And those are objectives which are far larger than the immediate objective of keeping the power cost low. So that is what is at play over here. We cannot be in this new age of renewables totally dependent on China, which controls 95% of the supply chain. So we need to ensure that there is a at least a 30% non-Chinese market. And if this were to be the case, that in that 30% non-Chinese market, India will have a larger and larger role to play. So we remain confident about one, the trend remaining intact, two, companies' ability to actually de-risk. So whether they de-risk from the point of view of geography, they will put up plants in US. From the perspective of addressing different markets, so whether it is domestic market, DCR market, solar rooftop solar market, C&I market, there are various other markets that they will be able to address. Third, by actually getting into products which are in and around the energy transition. So whether it is battery storage, inverters, so it will not stay limited to the solar module chain only. So there are many things that even companies can do to de-risk itself from this risk, and they are already doing that. So we remain confident about the theme and the companies that we have invested in.
So thanks, Ravi, for covering energy transition in a lot of detail. Do you want to cover one of the other two or three themes where we've been bullish on, maybe financialization of savings or discretionary consumption?
Okay, I'll take up the financialization of savings. I do believe that we are on the cusp of a 20-year kind of a run. Our savings, we used to be a 35% savings economy. That savings rate has come down to 25%. But that 25% used to be split 70% in physical assets and 30% in financial assets. That share is moving, the 30% share is moving towards 50%. So of course, there will be physical assets always, gold and real estate will remain. But incrementally, more and more financial products will become part of the portfolio. And it has been amply demonstrated in the last 3, 4, 5 years. Now, but this is only the beginning of the trend. If you see, we are still at about unique demat accounts of probably between 5 and 6 crores. The total demat accounts are around 10 odd crores. So no way are we anywhere close to a level where you can say that the equities have kind of penetrated so much that we are going to see a large correction or something. Surely we can't keep going up in one direction. So there will be some adjustments from time to time. There might be some up and down. Some other asset class does well, equity doesn't do well for a certain period, some money goes out somewhere. All those kind of things will happen. But the larger 20-year trend of one, the financialization of savings, and two, a bigger piece of that coming into the equity market, both of that will remain. And yeah, I mean, that's what I mean. I'll let Samir add a few points if he wants.
Oh, well covered. I think, see, larger trend remains, and there will be a few beneficiaries. Again, within that, you have to be able to find your winners. That's it. I think it's well covered. We can move ahead. We have a lot to cover.
Yeah. So Samir, ValueQuest has been conservative in its pace of deployment since middle of 2024. We've taken probably 3, 4 months or even more to deploy, in the recent past. Have you accelerated the pace of deployment now?
Yeah, pace of deployment definitely has accelerated. I mean, obviously, when you have a correction, you have to take advantage of it. So definitely now it's in weeks versus say months earlier. But for us that the core criteria remains quality, growth, and valuations. All three have to take for us to finally action it. So the funnel is there. We have prices in mind. We have a lot of stocks in the funnel which we are interested in. And if the price comes, we are happy to buy. Volatility always you should use as an advantage. Volatility is not risk. These are not permanent damage to prices. In fact, I would say that a lot of these prices we are seeing on screen are happening on very low volumes. So, even if I want to go and buy a chunk, you are not going to get, even buyers in this market are not getting the kind of volumes that they want. So it is a test of conviction. Weak hands are going out, and whenever that kind of a thing is happening, definitely the smart thing to do is to be on the other side of it.
Perfect. So Ravi, a question for you on foreign flows. So what do you think will change the direction of foreign flows? We are now into the third year of consecutive foreign selling, and the recent sharp rupee depreciation may spook the FPIs even more. So in your view, when and how will the foreign selling stop?
So I just before this webinar, I tweeted a particular chart where we have seen about 19 billion or 20 billion dollars kind of selling from September to January. And this is the second highest absolute selling that we have seen. No, sorry, not second highest. There are two more instances. One was in global financial crisis was a $15 billion. Then the period from October 21 to March 23, the 15-month period after during the Russia-Ukraine war, post-COVID consolidation, it was a $35 billion outflow in a span of 15 months. And now we have seen a $20 billion outflow in a span of 4-5 months. So we are reaching a point where FIIs have sold about 0.5% of their own holding. And 0.5% of India's holding, as in India's market cap. So that is quite a large number. Usually markets tend to bottom out at around 1% maximum, but that tends to happen when in periods of crisis. So it has happened in global financial crisis, and it has happened during the Russia-Ukraine war, where around 1% of the India's market cap was sold. Now, the starting point from where this selling started, India's market cap was around $5 trillion. So 1% would mean about $50 billion. But of course, we have seen $20 billion kind of an selling. Does it mean we will see $20-30 billion more? For that to happen, we will have to see a major crisis happening. Now, the biggest thing that is different this time around is that none of the corporates are leveraged. It's not like we are in a serious structural economic downturn and the companies will take a lot of time to revive. The banking sector is all jammed up. Nothing that cannot be changed with the stroke of a pen. If a government decides to focus on growth, if RBI decides to focus on growth, which I believe they already have, then things will course correct. Only thing is, as the term used by one of the RBI functionary, that this is not the time to pump prime the economy. So what it means is they are looking for a more gradual recovery than an instant start to the economy. So that's what we should be anticipating, that there will be a gradual recovery in the economy from here. And if those are the fundamentals, then I believe the FPI selling is closer to getting over than it is to begin. On a last 2 decade, FPI holding is now close to 16%. The domestic holding has also reached about 16%. So the gap is now barely 20-30 bips. So domestic institutions own as much as foreign institutions, and foreign institutions have actually become less of an influencer of what happens in the market. So we have corrected 12% from the peak. Can we correct 15% or 16-17%? Cannot rule that out. But do I believe it can lead to a 30% correction? I am not in that camp that we will see another $20-30 billion of outflow and a 30% correction overall in the market. That is not my base case.
Now, just to add, I mean, on a lighter note, then we should be worried about domestic selling than FII selling, because that is, but more,
if the flows keep coming, the domestics don't have a choice.
Yeah, there is so another data point is that 21-22, when we had similar in a calendar year, it was 20 billion plus of selling, and that was followed by 20 billion plus of buying by FPI. So they are, whenever it is global uncertainty, there was no crisis at that point of time also. So if you see that money came back, right next year.
Okay, yep. Thanks both Ravi and Samir. So Samir, an interesting subject, IPOs. So do you expect the IPOs to also be impacted based on the recent market conditions, in terms of quantity, quality, as well as pricing of those IPOs? Also, it will be good if you could explain how ValueQuest has been able to take advantage of good pre-IPOs and IPOs based on, some recent vehicles that we've launched. Do you expect that you'll get better opportunities in IPOs going forward?
The answer to the last question is definitely yes. Valuations, the only thing I think that will change is that valuations will become much more reasonable. I don't think we are in a kind of situations where IPOs will be postponed big time or anything. This normally happens to, say Paytm kind of IPOs where you want to obnoxiously price the IPO and, come to the market. So those kind of exits, I don't think private equities are going to get, in these market conditions. But like in this week itself, I met two fantastic companies, large, fantastic companies that are coming IPO. And I'd be very glad if, they come to the market with, reasonably priced. I was also looking at, one Kotak report yesterday, which said that there are 100 fundraisings that are going to happen, which is already filed with SEBI. So I don't think that intensity is going down. I can see, team, there is a substantial amount of time that we are also spending on these new IPOs. And what you mentioned, that this, if you are able to get pre-IPOs or anchor allocations in good companies which are priced reasonably, I don't think, even after the fall, most of the IPOs where we have participated, we are sitting on handsome gains. There is maybe, one odd where it would still be trading lower than that IPO price. But otherwise, in general, I think, that IPO market still, especially some of the unique ones where, it's a unique industry, etc. Those we are quite focused and interested in the IPO side of the story.
So I'll just add to that. Basically, the quality of company, any time, even in good times of IPO, we don't participate in each and every IPO. We are very selective in terms of choosing, and our framework is: one, it needs to be a unique company. Second, we need to see some margin of safety. And third, we need to have a deeper insight and some access to the management. And only when these three conditions are satisfied is when we participate in an IPO. So there might be some valuation correction in the IPOs. There might be some timing delays that might be possible. But like Samir said, there is no, this juggernaut is not going to stop this year. In fact, I won't be surprised if it turns out to be a bigger year than last year.
Yeah, interesting. That'll make investment bankers happy. Okay, so now, either of you can answer the next question. So we've been getting incoming inquiries about the right time to top up. So is this the right time? Will some of the top-up funds go into new ideas?
I'll take that.
Yeah.
Sure.
Absolutely, if markets have corrected and the money is meant for a 3-year period, then we are absolutely comfortable taking it. Only issue would be if the expectation is that the moment we put money, market will bottom and I will be up in 3 months' time from now. If that is the expectation, then there is no way for me to say if that is going to turn out to be right. If it turns out right, great timing, but that's not what I would recommend. Come with the rational expectation of making a mid-teens return compounded over a 3-year time frame, and come with the expectation that the money will be deployed over the next 4, 6, 8 weeks. Then I think absolutely no right time to be topping up the funds. Samir, anything you want to add?
Maybe on the new ideas bit?
Yeah. So Yeah, I know the expectation would always be that new shiny thing, but if something that and something that you own is available 20% cheaper, then we will do what is right for the portfolio in terms of portfolio returns. All these things doesn't matter. It is where money will go, where conviction is there, and we have to have that price value or risk reward matrix stick. But I can only say that the funnel of new ideas is also flowing, and we have enough number of stocks that we are evaluating. In fact, this is the month where, as a team, we are going to meet north of 70-80 companies. So there is a lot of work on the ground that is happening. So I am also thinking that we'll get new ideas as well, and that is where if we really come across something both the ways, like what Ravi mentioned, that when the bottom happens, or whatever, when things have turned, so we will call it, or we'll try to call it at that point of time where we will table thumpingly say, but it the money will be deployed only when there is conviction or whatever. Even if, say, money comes today, it is not that it is going to get deployed to tomorrow brainless.
Okay. And there is a similar question, and a lot of investors are in this camp as well. So the question is, someone who is fully invested for the last 2 years and does not have money to top up, how, as a group, you ensure sector reorientation happens so that the next leg of the bull run can be captured in the individual portfolio?
So there are 2-3 changes we are monitoring, keeping on radar. So a lot of people are taking, after this budget, taking a hard stance that consumption is the new shiny thing and capex is done for. We are not in that camp. Yes, incrementally, consumption is something that comes on our radar, and incrementally, capex is something where we will be a little bit more skeptical about paying a top dollar. So that is absolutely there. From the point of view of capturing and identifying new themes and ensuring that they get featured in the older portfolios as well, the next 3-6 months are that transition phase where we will see the market changing its color, changing the themes that will do well. And it will be a top priority for us to identify which are the themes that are losing luster and which are the themes that are going to pick up in a big way. And we will adjust the sales accordingly. But again, at any point of time, we have at least 4 themes represented and 7-8 sectors represented. So one theme here and there is not going to move the needle in such a big way. So it will be a 10 to 20% kind of a shift from existing ideas to newer ideas is what I would anticipate.
Okay. Now, another interesting question. We still see valuations of most of the mid and small cap companies very high compared to historical standpoint, even though they've corrected a bit, but compared to historical standpoint, they're still high. So given that nominal GDP is likely to be around 10%, do you think there is more pain in the small and mid caps?
Unfortunately, this question doesn't seem to go away. The mid and small and large cap thing. One has to understand large cap is top 100 companies, mid cap is next 150 companies, and small cap is next 250 companies. For us, the universe is about 800 companies, which is 100 crore plus profits. Now, to say that 400 companies, this cohort of 400 companies will not do well, does not make any sense. For example, if I were to tell you that the niche that we are bullish on in the pharma is the pharma intermediate chain, which caters to the a GLP-1 opportunity or some contrast media opportunity or some other such opportunity, then there are no large cap companies available in that. Our starting point is always which is the business that we see having maximum tailwinds over the next 3 to 5 years. And then if we see in that opportunity, which is the best positioned company or the larger company that we can bet on. So from that perspective, I mean, in this kind of a correction also, couple of 2-3 of our portfolio companies have gone on to make a new high. How is that possible? Because the numbers have been strong and the numbers look like they will continue to be strong for another 2-3 years. So then the whole idea of slicing and the market into mid cap, large cap, small cap, it makes sense for a mutual fund to probably look at it because they manage 10 lakh crores of money. For a concentrated portfolio manager on the alternate side who curates the portfolio, it does not make sense to slice the bucket into large, mid, and small. Sure, we also keep a track of it, and we are in general more skeptical about the valuation that we are paying. We are aware of the fact that there is a lot of money that has flown into it. But even in this, out of the 400 companies, not every 400 companies have done well over the last 4-5 years. It would be probably a case of 300 companies have done well. Now that universe will most likely narrow to 100-150 companies that will continue doing well, and not 300-400 companies. So my job as a portfolio manager is to identify which are those 100-150 companies and which are the ones that I want to participate out of that in the 10-15 opportunities. But if to say that there will be no mid and small cap that will do well because the nominal GDP is 10%, I think that is like talking in two different silos. GDP and it's not the GDP. What we have to track is the corporate profit, whether it is growing or no, whether the tailwinds are developing in a particular sector or no. Is there a possibility of a non-linear growth somewhere or no? And if the answer to all those is yes, then we have to identify those companies. It doesn't matter if it is a small or a mid or a large. The best money is made when a small cap becomes a large cap and a mid cap becomes a mega cap. And for example, we bought Polycab when it was 15,000 crore market cap. It's a 1 lakh crore market cap now. We bought Hitachi when it was a 20,000 crore market cap. Now it's a 60,000 crore market cap. So when the buckets change is when you make the maximum money. And we are looking for those companies that can change the bucket. So we are not going to be put into a silo of buy now large cap because some large fund manager is saying in the mutual fund.
Ravi, $10 billion is also mid cap and $3 billion is also small cap. So these are the top 500 companies or 600 companies in the country. And in fact, what is manifesting in the market or with the companies is also the mid and small cap in terms of performance, business performance, are doing well. And large caps have oil and gas, and say there is so much, metals, mining, whatever. So this bucketing is an old concept. We started last year also with the same kind of a thing. Will large cap outperform?
See, unless what happened in 1819, where SEBI segregated into large cap, mid cap, small cap, and that led to a forced selling in those buckets. Unless some event of that sort happens, it's not going to be that entire mid and small cap market is going to suffer.
Yeah, no, that point is well made. Okay, so there are some questions in the chat room around downside protection. So how do we ensure that we are managing the downside risk, preventing capital loss beyond a certain level? Do we follow any technical stop losses, or is there a fundamental stop loss? So can you just talk a bit about that downside protection and overall risk management?
So the simple answer first, no, we don't have any price-based technical analysis that 20% is maximum losses we'll see and then we'll sell off. That is the absolute opposite of what we do. We are focused on the fundamentals. We are focused on the company. We are focused on the industry tailwinds. We are focused on the capital allocation decision that the company is making, the possibility of what kind of profits that the company can earn over a 3-4 year period. And as long as those fundamentals are right and the company is executing as we expected, we will continue to hold. And if somebody believes that having these price and technical stop losses, that is I don't know what to say, but it is absolute not the way to be creating larger wealth. Nobody has become rich by taking all these technical losses. One has to stay focused on the fundamentals from a medium term perspective of 3 to 5 years. Now, for sure, if we are unable to justify that a company can double its earnings in a 3 to 5 year time frame, or we believe that the stock cannot double in 3 to 5 years time frame, then we will exit out of that. But it will not be a price based decision. It will continue to be a fundamentals based decision.
But Ravi, I mean, just elaborating on the question is basically downside or risk management part of it. If we say potential is fine, but it is fundamental. There is a fundamental stop loss in the sense we are not married to the stocks that we own. If what we expect is not going to happen, then irrespective of where the price is, we exit, and that has been amply demonstrated. In fact, that protecting the downside is a large part of finally whatever return that we have to generate. So we have very, very active monitoring. We have an investment committee every month where everything is discussed. So for at the slightest where we see risk, obviously, as I said, volatility is not risk. As long as company is performing well and price is going up and down, those will not be action. But if there is a problem with company performance, we will not be emotional about it. We will cut our losses and move on.
Okay, so Samir, maybe this question's for you. We had touched upon niche pharma briefly earlier on the call, and we also put out a report on the CRDMO space. So there's a question which mentions that the US Biosecular Act is, scrapped and not passed as a bill. Will that impact the CRAMS and CDMO opportunity? How do you look at the story panning out there?
So actually, I mean, if you see our thesis or whatever we have bought was even before this noise about Biosecure Act came into being. So see, the thing is again dependent what Ravi said. Philosophically, do you want your country to depend 100% on China, or 80% or 90% on China, or do you want an alternative source, especially on the CRDMO space? I have met 3 companies in this month, and everybody is saying in terms of inquiries, the funnel is only growing. So Indian companies, in terms of capabilities, in terms of capacities, are growing, and you are seeing more and more inquiries. And these are slow changes. See, nobody can change supply chains, overnight. And especially in pharma, when you are researching a drug, there is already a pipeline. What you are working on today is going to come to market 6 years later. So whatever has gone into the filing, if you have a partner, you are not going to overnight change it, even if Biosecure Act comes. If you see, Biosecure Act also, had that applicability from 31 onwards. So in whatever shape and form, but India in that space is growing. Again, we have said in our report that, not everything. We are not going to have a Wuxi Pharma from India, in 3 years. But yes, organizations, we have a right to win in the space. We have companies which are kind of able to compete globally with or without any kind of government incentives. So in that sense, I don't think this Biosecure Act, if it comes in some shape and form, then that will accelerate it. But this is an irreversible trend. India has a right to win here, and a lot of companies in the space are going to do well. But and I really think that you will also see some regulatory tailwind developing, which will accelerate it. So nothing. This Biosecure Act has not changed anything in our thesis whatsoever.
Sure. No, thank you for clarifying that, Samir. Now, again, there are lots of questions on energy transition. I know that both of you all have covered that, but there are questions around segments and subsectors within energy transition, including areas like hydrogen and so on. Maybe Ravi, do you want to just highlight where the imminent opportunities are and where we are currently positioned and what we are avoiding because the opportunities are not imminent, just to clarify the multiple questions which are there on that segment.
In energy transition, you're saying?
Yeah.
So there are 2 buckets within energy transition. First of all, let me lay out which are all the buckets in energy transition. There is nuclear, there is wind, solar, then there is biofuels, then there is cables, conductors, transformers. There is EVs. In the EVs, there are two-wheelers, three-wheelers, passenger vehicles, CVs. Then there is new age technologies like battery storage, hydrogen, ammonia. So there are many buckets under energy transition. But we, at this point of time, are bullish only on two opportunities out of that, which is power transmission, and second is the renewable supply chain, and within that, solar specifically. And the third one is, of course, the biofuel. These are the three segments that we are bullish on. Why? Because we believe it has the technological certainty, it has the unit economics in place, it has the regulatory tailwinds, and there are business models which are scalable and profit pools that can grow and can remain protected for a period of time. So that is our framework in identifying which subsector within the mega trend of energy transition to focus on. If we believe any of those criteria are not met anymore and market is changing, we will change our view. But at this point of time, it still remains the same. So was that the question? Did I answer your question?
Yeah, you did. Okay, now there are several questions on the currency moves as well, and variants of the questions. So there are some questions around how resilient is our portfolio to sharp INR moves. So if you could address that, and then there are some investors who want to know how much more can the rupee fall if the dollar continues to strengthen. And sometime back, maybe in the last 6 months or 1 year, we've talked about the twin deficits reducing, the current account deficit and the fiscal deficit reducing, and that should potentially help the rupee stem the depreciation. So when will that story play out?
Yeah, no, so that story, I'll take the second question first, which is that story seems to be getting pushed back further and further. We don't, at this point of time, have any confidence that it is reversing at any point of time, but it will at some point of time in this decade, is what I feel. Now, it's not something that we can play on at this point of time. It's not reached that inflection point. The concerns about rupee depreciation actually are now slightly dated. We should have been more worried at the level of 82, 83 when it started depreciating. I think now we have reached a stage where, the earlier governor and the RBI spent almost $70 billion trying to control the volatility in the rupee. And now they have actually let it go. So we have seen almost a 8-9% kind of a depreciation in rupee. And for the time being, I believe we are close to being done. So it's not a concern anymore. Regarding how we are, what are we doing in our portfolio? We do have exposure to exporters, and they tend to be the beneficiary of the rupee. There are not too many importers in our portfolio. So that from that perspective, we are not going to be directly impacted by rupee depreciation. In terms of, I think in the previous question there was some this thing about which are the imminent sectors that might do well. As I mentioned earlier in my speech, that incrementally consumption and healthcare are two spaces which will see more which will feature more in our portfolio, and less of capex oriented stories. But it is not going to be an overnight switch. It will be something that will happen over a 3-6 month period.
Okay, we have time for two last questions. So, I'll maybe Ravi, I'll pose this question again to you, and there's an interesting last question which I'll want both of you to answer. So, the second last question being, and I'm asking this because this space straddles both the private and public investments of ValueQuest. So, a lot of innovation is taking place in the Indian aerospace sector. Are there specific areas within the sector, such as satellite manufacturing, space exploration, or defense contracting, that you believe hold particular promise for investors, and why? And what is the long-term outlook?
So I wish my aerospace expert was here to take that question. But no, we are a very, very strong believer in the opportunity over a 10-15 year period. What we believe is that defense, and especially aerospace within that, is an opportunity that is going to pan out over the 10-20 year. What is happening is that post-COVID, the two main aircraft supplier on the civilian side and on the defense side as well are all facing serious supply chain issues. There is a lot of manpower issues in the developed countries, and they are looking for an alternate supply chain. And India is the only place that can provide that alternate supply chain, because with China, they have been a little liberal in infringing on the copyrights and intellectual property of the West. So they are not comfortable making China as a part of the supply chain. So China is actually going to be out of this particular supply chain. So India is the only place where there are a large number of engineers available which can be trained to become part of this particular supply chain. So aerospace will become a much larger sector in India. The order flows are beginning to flow to these private sector entities that are part of this particular supply chain. At this point of time, there are not too many companies represented in the public markets from the aerospace sector. We have one company, which is Unimec, and we have exposure to that. It is essentially an aerospace tooling company, basically with Indian market itself becoming a 1600 aircraft market. The civilian space aircraft market means more maintenance, repairs and overhaul will need to be done in India, and that means more tools will be required. So, but Unimec is not only a domestic story, it is a global story as well, and it is emerging as a large it will emerge as a large player in this particular supply chain. Similarly, there are other such stories which we are constantly monitoring. Unfortunately, in the listed space, they will probably take 1-2 years to get listed in the market, and we will be eagerly waiting for those to get listed.
Which is
Okay.
a short answer to that would have been that we are very bullish and we are launching a fund focused on, these sectors.
Yeah. Perfect. Okay, so last question, Samir, maybe first to you and then Ravi. On the behavioral finance side, how does ValueQuest keep their mind calm in such markets?
Be on the ground, meet companies. That's my noise with respect to prices, or you sit in office and listen to the noise or TV channels or screen. It's better to go and meet companies. Business acha hai to you don't have reason to worry. So that is the only way. There is no other way. You have to be constantly at it. All these worries are there, and why we are able to talk confidently is because we have gone, evaluated, spent hours on it, with various players within the ecosystem, and then you are able to form a view. So that's how we do it. No shortcut.
Ravi, your thoughts?
So we have a very strong core and quote coming from our founding family, which we follow. Don't buy on impulse, don't hold in hope, and don't sell in panic. If you do these three things, you will be fine, and keep developing conviction in your positions. As long as you have fundamental conviction, the price is only there to be taken advantage of, either to buy or to sell.
Well said. I think that quote was, really it captured everything. Great. Thank you, Ravi. Thank you, Samir. And thank you to all the attendees for attending. Thank you to our investors and channel partners for your support. And look forward to an exciting year. And hopefully all of us should be, happy with what we see, in terms of our portfolio, in the next few months. Thank you all and have a good weekend.